Hi, everyone. Welcome to the ETF show here at the New York Stock Exchange. I'm joined by a very special guest, Aram Babikian, head of Xtrackers Wealth, U.S. Onshore at DWS, and it is so wonderful to have you here. First, before we get all into it, can you talk to me a little bit about Xtrackers by DWS?
Sure. Thank you for having me, first of all. So Xtrackers by DWS is the ETF arm of DWS. DWS is a global trillion-dollar asset manager. We have offices in over 20 cities, and we view ourselves now as the gateway to Europe. And DWS has three distinct business lines. So we have alternatives, we have active fixed income and equity in a mutual fund format, and then we have our ETF division with Xtrackers. Xtrackers manages about $365 billion globally, $28 billion here across 41 different ETFs in the US.
Speaking of global geopolitical risks are on the rise these days. How would you advise investors with that type of exposure? How does it affect their portfolio?
Well, geopolitical volatility has increased in a tremendous way, and it's one of those areas where if you ask an investor how are they managing that risk in their portfolio, there are very few ways to do it where you stay 100% invested in something. Usually you're taking away from something else. So maybe you're buying gold, maybe you're buying Bitcoin, maybe you're going into a long short strategy or whatever it is, but it's differentiating from staying long only. And we believe in our three principles here at Xtrackers of innovation, access, and value, where we're trying to create innovative products that give you access to various markets at a attractive price point. So we came up with an ETF called CRTC. CRTC is a very unique strategy that actually follows the DoD's mandate of 14 critical technologies. So taking a step back, in 2022, the DoD, on a bipartisan level, came out with a list of 14 critical technologies: AI, quantum computing, cybersecurity, directed energy, biotech, wireless technology, and many more. And within this area, they've realized that under the guise of U.S. national security, there's going to be heavy investment in order for us to be technologically dominant and economically viable in the next 10, 20 years. So trillions are going to be flowing into these areas. So on one side, CRTC follows where trillions are going to be flowing. But on the other side is where the geopolitical volatility comes in. Realizing that the space between some of our adversarial nations like China, Russia, Iran, and North Korea has only increased over the past 5 years, and it's going to look vastly different in the next 10 years since the last 10 years. We work with a company called J.H. Whitney. J.H. Whitney is a defense contracting firm and data analytics firm. They developed an algorithm that looks at geostrategic risk. So it's a geostrategic risk rating that they developed, and they look at each company and their entanglement risk with adversarial nations. So if you imagine sort of the Golden Gate Bridge from California to China, and you see that there's this increasing distance, well, what happens to anyone that is in the middle? It's collateral damage. And there are certain companies that you're seeing where they have supply chain, they have revenue sources that are very significant with these areas of increased risk and entanglement. So what this ETF does is simultaneously giving you access to the technologies where trillions are going to be invested, but also analyzing companies on a 10-point scale on supply chain, revenue, board construction, and so forth, and creating a basket of stocks. Right now it's about 226 names, and it changes over time during rebalances, but giving you a way to invest where you're de-risking your portfolio for geopolitical volatility, as well as investing along the lines where you're going to see a lot of heavy investment from the U.S. government and technologies.
Let's talk a little bit about the global investment environment for a moment here. It seems that a lot of stocks, international stocks, have been favored, including Europe. Why do you think that is so, and do you think that trend will continue?
So my personal belief is I think we're in the first innings of a long game when it comes to Europe. Now, we've heard this story before to a degree, but I hate using this cachet of this time is different, but it truly is. And the reason is there's fundamental changes. There are structural changes. This is sort of a sea change. What Germany has put forth recently, and they haven't even started spending yet, this $1 trillion stimulus package. Now, that is in infrastructure, that is in defense spending. But in order to do that, there were changes that needed to be made to the Constitution. There were changes that needed to be made for debt ratios and so forth. This hasn't been done before, if I'm not mistaken, since 1945. So when changes like that occur, and the reverberation of such a stimulus package, it's going to go throughout Europe. Germany is the number one economy in all of Europe, and $1 trillion into a $4 trillion GDP is similar to $6 trillion into a $24 trillion GDP here in the US. So when that occurs, you're going to see that reverberate throughout, and that's going to affect a lot of things. Then you also have sort of the changing dynamics that's been brought about with this current presidency, and this president has forced a lot of these countries to look within themselves. So you're combining now, you have the first umbrella, which is the stimulus package, but then you also had a value play. Europe is still trading anywhere from 30 to 40% PE discounts relative to the US. So when you have investment into an area with these kind of valuations, it looks very attractive.
All eyes are on the Fed this week. They're expected to cut interest rates. Where do you see this affecting the economy, and do you expect more rates to be cut later on this year?
I do believe that we'll have some very methodical rate cuts. If you look at the way Powell has been operating, it always has been data-driven. It has been very methodical. If I'm a betting man right now, I'm looking at where today's meeting is going to take us. I'm probably assigning 50% probability to 25 basis points, 30% probability to 50 basis points, and 10% probability to maybe something higher than 50 basis points, and 10% possibly to no change. But obviously, I believe that is on the lowest end of the scale, and we are going to get a rate cut, hopefully. But it really is about normalization of the yield curve and understanding where we're at historically. We're still relatively high, although it is a very weird scenario because you have a lot of opposing forces. You look on one side of the coin where you have inflation being a bit stubborn, but then on the other side, you're seeing potentially a slowdown in employment. We had almost a million revision within the jobs numbers. That is the largest revision ever. So there's that. You're also starting to see little pockets where, for example, subprime auto loans are starting to look very similar to 2020, and the delinquency rates are, if I'm not mistaken, even higher now. So there are pockets where you're seeing the consumer slowing down a bit, which warrants a rate cut, and then there are other sides where you're seeing inflation be a bit sticky. But again, using these words that we don't necessarily want to use before, everyone seems to say it's a bit transitory. So let's see what happens. But I do believe we do get a small rate cut today.
Aram, thank you so much for the time, and thank you so much for the insight. And that'll do it for here at the New York Stock Exchange. I'm Michelle Yu for Asset TV. We'll see you next time.